So we utilize a strategy called a 721 exchange or an UPREIT that alleviates all of these problems. The beginning of a 721 exchange is exactly the same. You would sell your property and roll the proceeds into a Delaware statutory trust. In our instance, we invest in high-quality institutional apartment buildings in high-growth markets. So let's just say it's a $100 million apartment building in Dallas, Texas. You would own that building for approximately 2 years. You'd get all the cash flow from it. If it appreciated, you'd take advantage of the appreciation. You would write it off on your taxes through the Schedule E, just like normal. But our exit strategy is different. We have a diversified flagship real estate fund called the IncomePlus Fund. And after 2 years, the IncomePlus Fund would have the right to acquire that DST interest from you. Instead of giving you cash, which would necessitate another 1031 exchange, we would give you operating partnership units in the larger fund. That would be tax deferred under a different section of the tax code, section 721, or some people call it an UPREIT. So now you go from owning a single asset into a DST into a broadly diversified portfolio. So you can think of it like, instead of owning a single stock, now you own a mutual fund. So we're de-risking our portfolio by adding diversification. The 721 also requires no more swapping. You would just stay in that fund indefinitely. And we believe at Origin that one of the best paths to wealth is to stay invested into risk assets for the very long term without the frictional cost of taxes and fees. So by staying in that investment for longer, just like Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. So this will help you build your wealth in a tax-efficient manner and pass it on to your beneficiaries in a very easily divisible security with a fully stepped up cost basis and no burden of management.